Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about, arguably, in my opinion, one of the most important topics that goes along with any type of options education, which is trading psychology, and predominantly around how to manage risk and how to manage your account. Because most traders, I will say, in my 15 years of dealing with or helping both retail and institutional investors, the toughest thing is dealing with losses and dealing with how to manage your risk, how to manage your account, whether it's a winning trade or a losing trade. And what sets professional traders apart from everyone else is not really their indicators. You know, a lot of beginners or a lot of traders believe that professionals have access to better strategies, they have access to better information, they have access to faster information, but rarely is that the actual reason why certain traders are more successful than others. In my 15 years of doing this, what I've noticed, what's strikingly different between successful traders and everyone else is how they think about risk and how they go about managing risk. So today what I want to do is I want to introduce to those of you that are new to this topic. Some of you have heard this topic before, but for those of you that are currently either in the learning process of trading or you're learning how to trade options, how you should think about your trading psychology. How do you actually tackle each individual trade? How do you think about your overall portfolio in the context of each individual trade? Because the way that you think is, once you shift your way of thinking in terms of what's important, what's not, that is really what's going to accelerate your growth and the potential of your trading account. So today I'm going to break that down for you, hopefully help for those of you that are perhaps struggling or feel frustrated with your trading, help you better understand as to what's causing some of that and how to shift your thinking into the ways that professional traders think about their portfolios to hopefully help turn around or stem some losses, especially after a tough couple of weeks in the markets. Some of you may have had some significant losses in the markets over the past few weeks. I think this is a very timely topic to be talking about this to help you better understand navigating your portfolio going forward. Before I get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for those of you that are brand new to OptionsPlay, you can register for a free 30-day trial, which will give you access to the tools that we'll be showing you here today, along with access to education and the wealth of information that we have available for options traders. It's a free 30-day trial. Register at OptionsPlay.com. Today, we're here to talk about trading psychology and how professional traders and profitable traders think about their portfolio. But next week, what we're going to be doing is we're going to be wrapping up everything we learned in the month of September during our live market analysis session here next Thursday. What we always do with these types of courses is every single month, at the end of the month, we, instead of marching on and keep going on new topics, we always take time to reflect on what we've learned and hopefully help you apply them to the real market. So please join us here next Thursday, a very special event. I love doing those live market sessions because it's also an opportunity for you guys to submit some symbols for us to look at them together. Now, every single Tuesday and Friday morning, we do a market review. This gives you a better understanding as to how we're looking at the market from a macro perspective, what sectors are moving and why we're paying attention to certain sectors versus others, and then also share with you some of our ideas and economic research that we're looking at to inform our broader market reviews. So for those of you that have not been able to join us here on Tuesday and Friday morning, you can sign up at trade.optionsplay.com/weekly. So today, I'm going to first introduce trading psychology. And I'm going to first talk a little bit about some scenarios that you as an investor may associate or can relate to from your trading account and some of the struggles that you might come across. So I want to hopefully show you that the concerns or some of the frustrations that you might have in your account is certainly not unique to you, and talk a little bit about how to trick your brain, if you will, or think, just switch the way that you think about trading to hopefully help activate a different way of thinking, because that's going to help you understand what's important to pay attention to and what's not important to pay attention to. Then we're going to talk a little bit about how to actually achieve this, and or what are some of the rules or things that you can apply to your portfolio that can help you actually achieve this. So the golden rule of risk management. And then what we're going to do is we're going to go through a little bit of math to go through why the golden rule of risk management is so important. And in order to understand that, we're going to talk about linear versus exponential functions. We're going to talk a little bit about blowing up your account, what that looks like, how to avoid it, and also account for consecutive losses, because the reality of trading is that you're going to have losses. Reality of trading is that you're going to have consecutive losses. And the question is, how many consecutive losses can your account sustain before you are in a position where you can no longer continue trading? And you might be surprised as the number of consecutive losses that you should be accounting for versus what you might find yourself that your portfolio or your trading size can account for currently. And some of the tricks that you can increase the number of consecutive losses before you blow up your account. And then at the very end, we'll open this up for Q&A for any questions that you guys might have. But the primary question that I want to help investors answer here today is really what sets professional traders apart from others when it comes to their trading. Like I said, a lot of beginners tend to think that it has to do with their strategy, maybe their technical indicators, maybe they have some special secret sauce. Rarely do I find that the best traders are ones that have some kind of secret sauce. Yes, the ones that are most successful have built some type of system that works for them, but what sets them apart, and many of these investors have sold those systems to other traders, but does that mean that someone else who bought that system can trade successfully? 9 out of 10 times, I tend to find that they cannot. And it's not because of the trading system. It's because of how they think about risk management. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Like I said, I've been a market strategist for 15 years, which means that I've been working with individual retail clients and institutional clients for 15 years. And I have seen just about every single possible trading strategy, account blow up you could possibly imagine. And it's very clear to me as to patterns that I see with traders that are successful versus everyone else. And like I said, it's not down to their indicators. It's not down to their strategy. It comes down to their way that they manage risk and how they think about risk versus reward, which one they pay more attention to. I tend to find that most beginners focus on reward. They focus on how much money can I make without really thinking about how much am I risking. And that's the difference between professional traders. They take all of their efforts on figuring out how do I minimize risk? How do I make sure that my portfolio stays intact? Reward will come as long as they're able to manage their risk. If they don't manage their risk, no reward is ever worth it. So that is the fundamental shift that I hope today will be able to enlighten for some of you that may find yourself struggling with trading. So I'm going to start off with a chart that I think many investors, especially if you're starting out or if you've been trading for a while, you can probably associate with, which is most trading accounts that I see, especially with options, tend to have has a series of small winners and small losers. And they may have small gains and start, building up their portfolio slowly. And then all you have is one big loss that takes out a large chunk of their portfolio. And then they continue this cycle again, where they grind their way higher until they have that one large loss that generates another big blow up in their account. If any of you can associate with this or found yourself in this particular scenario, please type 1 into the chat window. If you find yourself in this position where you have a series of winners, small losers, and then once in a while you just have this huge loser that blows a hole in your account. Sometimes that hole could be enough to blow up your entire account or maybe a significant portion of your account. And then you build yourself up again, and then you find yourself in the same position. So if you think about this, is it the strategy that's gone wrong here, or is it the risk management part that's gone wrong here? And that's what I tend to find, is that it's this one trade, and this one trade isn't down to strategy. It's not because your strategy is not great or the strategy is out of whack. It's all comes down to risk management. And another chart that I want to show you that I think many of you that can associate with this may also find yourself in the position of associating with, is this idea of being right, or trying to win on a trade. Because guess what? The market doesn't care if you're right or not. But as human beings, we want to be right. As human beings, our emotions want us to win. And that is actually what drives a lot of the psychology behind, what you should be paying attention to. So this is another scenario that I think many beginners or many traders, even traders that have been trading for a while, can associate with, which is, okay, you have a stock. The stock has been trading near its support level for quite some time. So the next time it approaches that support level, you think, okay, great, let me go long the stock because I think it's going to rally into that next resistance. What happens after you buy the stock? Instead of rallying higher, it starts to decline. So what do? Instead of saying, okay, I was wrong, that support level didn't hold, that was my original thesis, instead of just cutting your losses, what do? You say, well, guess what? Maybe that first support level didn't hold, but there's a second level of support down here. I think that's going to hold. So why don't I buy a little bit more? And when I dollar cost average, the stock doesn't have to move as far, and I can get myself back to break even fairly quickly. What happens after you do that? The stock continues to decline again. Now you're asking yourself, okay, I like the stock at 26 bucks. I was okay buying at 24. Now that it's down to 18, this is a really good bargain. So maybe I should buy a little bit more. And if I buy some more, then all it has to rally back up is into that $20 level, which is just, that resistance level here. As long as it gets back there, I'll get myself back to break even. I'll do one last trade to get myself back to break even. Guess what? That trade also doesn't work out and continues to move lower. And at this point, you start getting a little desperate because you've had, this trade all go south, and you start looking for other reasons to buy that are completely irrelevant to the reason that you initially bought this trade, which is the fact that it was trading at near a support level. Now, again, if any of you can relate to this, please type 2 into the chat window. You start looking at things like technical indicators and you say, okay, this stock is severely oversold. Let me buy some more. I know it's going to bounce higher. Guess what? It still doesn't move higher. It still starts to move lower. And you get really desperate at this point, depending on how much you've actually put at risk on this type of trade. A lot of people will say, this is a stock that I love. This is a stock that will continue. I know will turn around eventually. So I'm just going to keep buying or hold on to it forever until it gets back to break even. And what you're not thinking is, well, could this money be put in better places, right? A lot of people have losing stocks that they've held on to for months, maybe years, because they just don't want to take a loss. They don't want to take a loss but they don't think about, well, if I sold this stock at a loss, could I deploy this money somewhere else that's going to make me more money? And the answer is likely that's going to be true. So this is what generally blows holes in accounts, is this type of behavior. It has nothing to do with your strategy. It has to do with how you manage risk in your portfolio. So if everyone can associate themselves with having once in a while these types of large trades that blow a huge hole in your portfolio, and you can associate with being in a position where you've had a losing trade start to go south and you buy more to try to get yourself back to break even, only to get yourself into a bigger hole, it doesn't come down to strategy. It comes down to how you manage the risk on a trade, because a professional trader would have said, my thesis that the support level was going to hold is wrong. That's it. Cut out of the trade, right? I'm going to get out of the trade. Can that trader then later decide that, okay, there's a new support level, let me buy it again and see if I can make some money on that second trade? They may do that, but what they'll always do is cut their losses on that first trade and make a second trade, not based on the fact that they're in a losing trade, but as a second trade to say, is this now a better time to buy this stock? And those are two very different things in terms of trading. So why do I think trading psychology is so important? Why do I see, and what telltale signs do I have when I get questions from traders that I know that they're thinking about risk management the wrong way, is the type of questions that I get. Number one, the type of questions I get is, how do I repair a losing trade? What this tells me is that they're not concerned about losing money. They're concerned about winning. They're concerned about, how do I get back to break even? How do I win? How do I make sure that I'm right? But guess what? The market doesn't care if you win. The market doesn't care if you're right. The only thing that matters is how much money do you have in your account to continue trading the next day. And that's the real question you should be asking yourself. Another question is saying, how do I make my money back on a losing trade? remove yourself from the losing trade. The trade is done. You've lost money on that trade. Move on to the next trade. Don't let the losing trade cloud your judgment on the next trade. That's what ends up blowing up holes in your account. I also get a lot of emails, over the past few days as markets started to come down. I've been getting some emails saying you've had 3 losing trades in a row. Your service sucks. And what this tells me again is that you're thinking short term. You're thinking about winning. You're thinking about how do I win as much, thinking that if you just win, that you're going to be profitable. But the two things have nothing to do with each other, because you could win all the time and still blow up a huge hole in your portfolio from a single trade. So the question becomes, how do you prevent these large blowups in your account? That is really the question. And if you can answer that question, you can make sure that your portfolio doesn't suffer this large loss, and you actually continue your slow grind higher and higher and higher. And that's the goal here as to how to go about doing that. And someone saying, trading spreads or trading limited risk strategies. And on the surface, that sounds like that's one way to do it. However, what I've noticed here is that just because people trade spreads or limited risk strategies doesn't prevent them from continuing to buy more on a losing trade. So what I want to point everyone to here is a book that was written in 1986. And I'm not suggesting that you go out there and buy this book, because the book has nothing to do with trading. It's a book by an author named James P. Carse, and he was not a finance professional. He wasn't a broker or a trader. He was a religious philosopher, and he had a theory of an infinite versus finite game. So for anyone who's ever studied game theory, this is one of the underpinning theories of game theory. So the question is not, what's your right, are you trading the right strategy? Are you trading the right indicator? The question is, are you asking even the right questions to begin with? So when we look at finite versus infinite games, why is this important? Because we want to first define what game are we even playing. Because if we're playing the wrong game, that's where we lead to frustration. That's how we lead to account blowups. Okay, so James had this theory that there's 2 types of games: finite versus infinite games. A finite game is a game that we're probably all familiar with, like football, basketball, blackjack, or chess, where you have defined players and observers. You know exactly who's playing. There are fixed rules to the game. So before you play the game, you know exactly what the rules are. And at the end of the game, it will always end at a certain point, meaning each game has an end point. And at that end point, there's declared both a winner and a loser. So this is a classic example of a game that we're all familiar with. But what James also said is that there's another type of game that's called an infinite game. And in an infinite game, there are known and unknown players, meaning you're not exactly sure who all the players are. And there are no agreed upon rules. There's no rules to the game itself. There's just a game. And guess what? The game never ends. Now, so what happens in a game that never ends? Are there any winners or losers? The answer is no. There are only players in the game and players who drop out of the game. That's the end goal, if you will, or the end result of an infinite game. There's no winners or losers. You're either in the game or you're out of the game. Examples of this, so I think a good example of a finite game is the game of football, right? You have players on the field, and the goal of those players is to win the game based on the rules of the game. But an example of an infinite game is the National Football League. Can the National Football League ever win? The answer is no. But they are the dominant league at least in the United States. Are there other football leagues in the United States? There sure are. But guess what? We don't really hear about them. They're not really big players in that particular space. So guess what? The National Football League is the dominant player, and there's a bunch of smaller leagues, and those smaller leagues mostly are probably hanging on by a thread in terms of viewership, and they're unlikely going to take over the National Football League. But there's no winning, there's no losing. It's just whether you're in the game or you're not in the game. Same thing like starting a business, right? Is there any such thing as winning in a business? The answer is no. You're either in business or you're out of business. And what's your goal when you are in business? Your goal is to stay in business at all costs. Your goal is not to win. Your goal is not to be necessarily number one. Your goal is to stay in business. If you're running a casino, do you care about each individual hand that's played at your casino? No, you only care about, at the end of the day, do you end up with more chips or less chips? Which is very similar to trading. Trading is, I think of blackjack and running a casino is very similar to trading. If you think about each individual trade, it's like playing each individual blackjack hand, which is important. There are rules to that hand, but at the end of the day, you're not playing blackjack. You're trying to run the casino. You want to make sure at the end of the day you have more chips than you started the day with. Does that make sense? Trading is in the infinite game camp, not the finite game camp. So when traders ask me, how do I win? How do I win more often? What is the probability of winning? What that tells me is that you're asking the wrong question. You're thinking about trading in the wrong way because you're thinking about trading from a finite game perspective. But in reality, trading is not a finite game. It's an infinite game. So what we learn from this is the fact that when a finite player is playing an infinite game, meaning they're playing to win, what that leads to is just a lot of frustration because you're trying to win at something where there's no winning. You're trying to win trades, but guess what? At the end of the day, no one cares how many trades you win or how many trades you lose. The only thing that matters is how profitable are you at the end of the day, and can you continue to be profitable into the future? Does that make sense, everyone? Please type 3 into the chat window if this makes sense. And I know this, if this is the first time you've heard about infinite versus finite games, it's going to take a bit of a time to wrap your head around it. But it's such an important theory to understand that you're playing a game that has nothing to do with winning. That when you're trading and you're thinking about, how do I win every single trade? And a lot of beginners think that if I just win more often than I lose, then I'll be profitable. That's why I hear a lot of investors ask me questions. How do I find high probability trades? Thinking that if I just win more often, I'll be profitable. But again, the two have nothing to do with each other because you could have very high probability of winning and still blow big holes in your portfolio. And that doesn't help you at all. Okay. So this is the fundamental shift that you have to make as a trader, is to understand that I'm not playing to win, I'm playing to stay in the game. So what does staying in the game even mean when you're playing an infinite game like trading? The answer to it is actually really simple. So once you kind of shift your thought about this, the way that you think, the shift that actually happens is actually fairly simple. What you do is, instead of thinking about what do I do to win, you ask yourself the question, what do I do to protect my trading account? Because that's the number one goal. The number one goal is not winning. The number one goal is to prevent account blowups like this. How do I prevent that? And this is what we're going to explore here today. What are the things, what are the tricks, what are the rules that you can apply to your portfolio to help you avoid these account blowups? Because if you can avoid those account blowups, and I'm not saying that if you just did that alone that you'll be successful at trading. You still have to leverage your strategy. You still have to have discipline in the markets. But this is a big part of what drives a lot of underperformance for most portfolios. So today what we want to do is we want to explore what things can you do to help you avoid that. So I have a couple of scenarios that I want to bring up. And then these were real scenarios that someone asked me here today. These are members of OptionsPlay. I got their permission to share with you the position that they're in. And I want you to think to yourself as we go through today's session, if you're brand new to this infinite versus finite game, ask yourself, if you were in this scenario, and I think many of you may find yourself in similar scenarios here today, how would you approach this? How would you approach it before this session? And how would you approach it after this session? So here's scenario one. This was from a member earlier today who sent me an email saying, I sold one contract of a Facebook 292 put a week ago. And now that Facebook is trading around 260, how do I hedge this transaction? Should I sell another put at 260 and pocket the premium to break even? Or should I sell another at a different expiration for the 260 strike? So I think this is a position that many of us can associate with, right? And even if you sold, let's say, the Apple credit spread that we sold on our daily play a couple of weeks ago, you find yourself in a similar position where you sold something, the stock went lower, or sold a put, the stock went lower, and you're asking yourself, what do I do? Do I sell another put to try to lower my break even, collect a little bit more premium? Do I do something else? So if any of you can, first of all, relate to this specific position with any positions that you have in your account, please type 4 into the chat window where you sold some puts maybe 2 weeks ago and the market is now moving lower, or a credit spread and the market's moved lower, and you're asking yourself, what should I do? So hopefully after today's session, you'll have a different view as far as what you're thinking, because this person was originally thinking, how do I hedge my transaction? What do I do to get myself back to break even? How can I prevent myself from having to own the stock at 292? These are all the ways that some investors think. So hopefully what I want to illustrate, and I'll come back to this at the very end, is changing your views on how you think about this scenario. Second one is another trader sent me an email this morning saying, I bought an NVIDIA 525 call and I paid $3,566 for this call option. NVIDIA is now trending lower against my initial view and the position's down 38%. Should I sell or hold? And ask yourself, why would you sell and why would you hold, right? You're holding it because you think that hopefully this gets back up and that you're able to make your profits back. That's why we hope for that money to get back to break even. Why would you sell? What is the rationale for that? To protect yourself, right? So based on today's session, I hope that at the end of the day, when we come back to this slide later, you may have a different view as far as how you would approach one of these scenarios and how you would trade them yourself. So let's start at the very end, right? So we've talked about the problem. We hopefully I helped illustrate what the problem is with many investors and getting to that account blow up, because it's not your strategy. A lot of investors feel that it's their strategy, that they've gotten their strategy wrong, and they seek, professional advice. They sign up for newsletters. They try to follow other people because they're thinking that my strategy is not good. Let me follow someone else who has a better strategy. But 9 out of 10 times, following someone else with a better strategy still results many times in the same result. So what's the problem here? The problem is how you manage risk. So what I'm going to do is I'm going to jump all the way at the very end. I'm going to just tell you what the golden rule of risk management is, which is never risk more than 1 to 2% of your entire portfolio for any given trade. So depending on your portfolio size, your max risk on each individual trade should never exceed this amount depending on your account value. Now, we generally tend to say that the smaller the account you have, the more you lean towards 2 to 3%. I'm sorry, let's just say that the smaller your account goes, the more you lean to something like 2%. As you can see with $5,000, you really don't have a lot of wiggle room. There's not a lot of options that you can trade in that $550 to $100 range. And that in itself speaks to whether or not options trading is even suitable for an account that's as low as $5,000. I would argue that for most investors that you really need to have somewhere in the $10,000 to $20,000 range to even trade, that one contract of options these days. It's difficult, very difficult, in my opinion, to trade, an options account with just $5,000. So if you lean onto this lower end of the spectrum, you want to get into that 2% range, somewhere in this range. What that means is that you're going to trade less often, but you're still going to be able to stick within the rules of risk management. As you get higher account values, that's when you can lean into the 1%. And sometimes if you get into that $1 million range, you can even get into the 0.5% range. So somewhere in this particular range as you start to see larger account values. And then when you get into the really large account values, like I said, sometimes as low as 0.5% if you're pushing $1 million or even more. But the goal here, and I'm going to show you why these rules are in place, but the goal here is so that you have smaller losses and the max risk of each individual option strategy. The great thing about options is that options as a vehicle itself has embedded risk management built into it. When you buy a call, naturally, you cannot risk more than what you've paid for that call option. When you trade a spread, you have a max risk for that spread. No matter what happens, you cannot lose more than that amount on that spread. So options already have this embedded risk management function built into it, but nothing stops you from buying 1,000 contracts of a call option that costs $2, right? And you can potentially lose a lot more. So it comes down to how many contracts that you purchase. So you have to do that math yourself, and I will show you how OptionsPlay will help you do that math on the platform itself. But the second reason that you want to trade small is because smaller losses are much easier to accept and let go of. Because many times when you have an account blow up like this, right, where you buy a lot of stock and then you buy a lot more, many times that I find investors that they get into that third and fourth trade is because at that point they've already risked so much of their account, they can't really afford to lose that. And I know that sounds really counterintuitive, but many investors, what poker players call pot committed. They just feel that they've already risked so much money, they can't afford to lose it. They have to do everything they can to get themselves back to break even. So they throw this Hail Mary to hopefully get themselves back to break even. This is also how gamblers usually go broke. It's the same mentality. So this is really designed to help you hopefully avoid that, because when you trade small, guess what? It's much easier to let go of a small loser than a loser that's going to blow a 10, 20% hole in your portfolio. Just emotionally, it's much, much harder to do that. And for any of you that have ever been in that type of hole, emotionally, it's a very, very difficult thing to go through. It's an extremely stressful thing to go through. And this is hopefully to help you avoid that. So when you trade small, you're able to stay in the game at all costs by preventing your account from blowing up. So I want to talk a little bit about account blowups, because account blowups really kind of sneak up on you. The same way, and to understand this, we need to understand the difference between linear versus exponential functions. Now, linear versus exponential functions was something that was, prior to COVID-19, sometimes a little difficult for everyone to grasp. But as a result of COVID-19, I think everyone has now a better understanding of how exponential functions really sneak up on you. Because in the beginning of coronavirus, we would see that, each city had one case, 2 cases, 3 cases, and you're thinking to yourself, this is nothing, and after 4 weeks, it's still at 10 cases, 12 cases, and you're just saying, it's been 3 months and really haven't seen anything of significance. And next thing you know, this blows way out of proportion, and next thing you know, you're at 40,000, 70,000 cases. That's how exponential functions work. They start out really, really slow and then really creep up on you. And this applies to account blowups as well. How so? Because the amount of gains that is required for you to get back to break even after a loss, guess what? That number grows at an exponential function. Meaning, if you have a 10% loss in your portfolio, the amount to get back to break even is roughly the same, 11%. You lose 20% of your account, which is a fairly sizable hole. It only takes 25% to get back to break even, roughly the same. But as you get to 30%, it starts to creep up. If you lose 30% of your portfolio, you need a 43% return just to get yourself back to break even. That becomes increasingly difficult to do. At 40% loss, 67% to break even, 50, 100%, 150, 233. And as you can see at this point, it becomes impossible to get yourself back to break even. I would argue that anything below roughly about 25%, anything in this area is almost impossible to get yourself back to break even on your own without depositing more capital in your account. So anything when you've blown a 25% hole in your portfolio, it just becomes so difficult to get yourself back to break even. You have to remain so disciplined for so long just to get yourself back to break even, that even a small slip up causes that massive downfall in your account. So portfolio losses greater than 25% are very, very difficult to recover, which means that you should at all costs do everything you can to stay on this side of the triangle, of this line. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. And the next chart I want to explore is the number of trades that it requires to blow up your account. And the good thing is that this is where exponential functions work in your favor, because for every 1% less that you risk, the number of trades that is required to blow up your account grows at an exponential pace. So if you risk 10% of your account per trade, you need 10 trades to blow up your account. If you risk 5% of your account per trade, you need 20 trades to blow up your account. But if you risk 2% of your account per trade, you need 50 trades to blow up your account. At 1%, you need 100 trades in a row to blow up your account. Imagine having 100 losing trades in a row. I don't know anyone who's had 100 losing trades in a row. I don't even know that I think I know anyone who's had 50 losing trades in a row in my experience of trading. If you did have 50 losing trades in a row, I would suggest that you simply trade the opposite of what you are currently doing in terms of your overall strategy. And just because it's impossible to have that many consecutive winners or losers at any one time, which is why we always advocate that you stick to this type of rule, because it takes an astronomical number of trades to blow up your account or draw down your account. So you can actually prevent yourself from having those account blowups by sticking to these types of rules. Now, here's the thing. Risking 2% of your account per trade sounds like a really easy to trade, really easy rule. And many of you, may even follow this rule in your portfolio and still find yourself in the position of that first chart. So I want to talk a little bit about what else you need to do beyond just risking 2% of your account per trade. But before I move on to that, I do want to show you here in OptionsPlay what I mean by risking 2% of your account per trade, right? Because there's lots of different option strategies. Some have limited risk, some have unlimited risk. How do you actually deal with all of that? That's really where OptionsPlay comes into play. And I'm going to choose a few different strategies. Let's say I'm looking at a vertical spread, and I want to compare some credit spreads to some debits, some long calls to some debit spreads. How do you actually calculate what 2% of your account value per trade is? That's where we have a risk and investment calculator, which is the third dot at the bottom of your trading tab. We do the math for you. All you have to do is figure out what's 2% of my account. So in this particular case, let's say 2% of your account, let's say you have a $50,000 trading account, and 2% of your account is exactly $1,000. So what you should do is that every single trade that you should make should never exceed $1,000 as your max loss. So let's take a look at this position here. So let's say I'm willing to, what you can use, whoops, sorry about that. So if you are in a position where you're saying that I only want to risk no more than $1,000, what you can use is our risk and investment calculator. You can click on I want to risk, and you can type in $1,000. And what that will do is it will calculate for you, oops. And what it will do is it'll calculate for you the number of contracts that you can purchase or sell to stay within that $1,000 mark. Now, in this particular case, only the call credit spread, actually none of them in this particular case, notice how the max risk of each one of these trades actually exceeds $1,000. What does that tell me? That tells me that if I have a $50,000 portfolio, I should not place any one of these trades because each one of these trades exceeds my $1,000 risk. Now, this is a hard lesson to learn because many times you say, I love Facebook. I think this trade's great. I think it's going to make me money. And all you're thinking to yourself is how much money you can make. And you're not thinking to yourself, how much money can I lose? And when you do that, that's a recipe for disaster in the long run. It may not affect this one trade. Maybe you make money on this trade and you think to yourself, I'm a genius. I made money, more money than I normally would because I risked more and I made more. But all it takes is a few bad trades and that's going to blow up in your face. So it's really important that you think about how much are you willing to risk. So maybe Facebook at $254 a share is not the right stock for you. Maybe a lower price stock. Maybe GM is a much better trade for you because it's a $37 stock. And what you can do is you can look at different strategies. You can say, okay, I'm willing to risk $1,000 on this trade. And what it'll calculate for you is that you can buy 4 contracts of the call option, or you can buy 5 contracts of the debit spread. And this is how you can make sure that the risk that you take stays within your $1,000 maximum risk. So always make sure that you use the risk and investment calculator, which is available to you here on OptionsPlay, to calculate the appropriate amount of risk for your portfolio. So let's go back to this. So now that, like I said, even if you stick to that 1 to 2% rule, that doesn't prevent you from trading 30 trades at the same time. So I want to talk a little bit about how do you account for consecutive losses, because you can put on 30 trades that risk 2% each. And if all 30 trades go south, you've blown a 60% hole in your portfolio. Granted, that's not very likely, but we always want to understand, because we're not just trading one trade at a time, right? We're not placing a trade, waiting for that trade to expire before we place that next trade. Likely we have multiple trades all going on at the same time. So we have to not just look at the risk of each individual trade, we have to look at the risk of your entire portfolio. So in order to do that, we have to look at the probability of consecutive losses. So what I have here is the probability of having a certain number of consecutive losses across the top based on your win rate of your strategy. So on the very low end of the strategy, if you're just buying calls all the time or puts all the time, you're going to see about a 30% win rate. If on the other hand, if you're selling relatively high probability credit spreads, you're going to find yourself closer to 70%. But most win rates are somewhere in the 40 to 60% range for most traders. And what you can do is you can see what is the probability of having 5 or 6 consecutive losses or 10 consecutive losses based on your probability of winning. So what we usually tell investors is that at the very least, you should plan to have at some point 5 to 6 consecutive losses at some point in your trading year, meaning throughout all the trades that you make this year, there's going to be some point, maybe 2 weeks ago was that point, where 5 or 6 long trades that you all had became losers all at once. So you had, even though you risked 2% of your account per trade, but you had five or 6 losing trades in a row, guess what? You're blowing up a significant portion of your portfolio. So that's why it's important to not just say, I'm risking 2% of my account per trade, I've done my job. That's not enough. You have to look at how many trades are you making, okay? So the goal here, again, is to try to keep that the percentage of the amount that you risk multiplied by the number of consecutive losses. You want to make sure that that's less than 25% of your portfolio. So if you risk 2% of your account per trade and you have 5 consecutive losses in a row, what that means is that you have about a 3.13% chance, which is this number right here. And I'm going to select, let's say you have a 50% win rate, right? Let's say your strategy is a 50% win rate. That means that you have about a 3% chance that you're going to lose 10% of your portfolio at some point in your year. That means that if you look at your account portfolio like this, you're going to have one trade a year you're going to have about a 3% chance that at some point you're going to take a 10% hit. Now, like I said, most portfolios can generally recover if you have a 25% hit at some point. It's going to take a little bit of time to recover, but that's an amount that you can recover from. If you have a 10% loss, that's something that's much easier to recover from. But this is how you can get a better sense for how much risk are you taking on each individual trade, but also how much risk are you taking from an overall portfolio. So if you have a really high win rate, you have a lower probability of having those 5 to 6 consecutive losses. If you have a lower win rate, you're going to have a higher probability of having 5 to 6 consecutive losses. So you can look back at your trading history, look at your win rate based on your strategy, and you can see based on your win rate, roughly what's your probability of losing, about 10% of your account per trade. Now, here's the thing. Many times investors will say, okay, then, I understand that I've placed my trades and I'm comfortable with that. But the one thing that you also have to consider is the fact that if you have a lot of concentrated positions, you can't think of them as individual trades. You have to think of them actually as a single trade. So for example, if let's say you had 3 technology long trades that all expired on the same day. Let's say you were long Apple, long Facebook, long Google, and they all expired on the October expiration, and they each risked 2% of your account per trade, and they were all long. Guess what? That doesn't really count as risking 2% of your account per trade. That's almost like risking 6% of your account per trade, which certainly exceeds your 2% rule. Now, if those are the only 3 positions that you had on, that's okay. But keep in mind that if you have other positions on, now you have this one position there that's really risking 6% because you have to distribute your trades across expirations, across long short, and think about the sectors too, because sectors are fairly highly correlated these days. So if you have a lot of long, similar sector names and all expiring in the same day, or all short in the same sector in the same day, expiring on the same day, you have to group those together and think about your portfolio risk from that perspective. So many times someone will have, let's say they'll stay within the 2% rule. Maybe they have 2 trades on each expiration cycle. So when they account for those 5 consecutive losses, what they're looking at is about a 3% chance instead of a 10% loss. They're looking at about a 3% chance of a 20% portfolio loss because they're trading 2 trades per expiration cycle. Now, on the flip side, some people load up on expiration cycles. I've seen people with 5, 10, 15 trades. For those of you that joined us on Tuesday with Tom Sosnoff, he has a lot of positions. So he has a lot of concentration risk on each expiration cycle. So if, let's say you risk 2%, but you had 5 positions all expiring on the same day, and perhaps you had 5 consecutive losses, that's a 3% chance of a 50% portfolio loss. So the number of trades that you have expiring on the same expiration can greatly increase your portfolio risk. And this is something that's very important to pay attention to on your account. But there is one other way that you can further reduce the amount that you're risking, which is placing a stop loss on your trades. And this comes down to the trade that I showed you here before on that long NVIDIA trade, right? Just because you bought something for $3,600 doesn't mean that you have to hold it to zero, especially once you recognize that the trade's no longer going in your favor and maybe you've lost 30 to 40% of the premium that you paid. You can get out of that trade and say, look, I was wrong on that trade. I thought the stock was going to go higher. It didn't go higher. Let me keep the premium that I still have left for that next trade. And this can significantly reduce the portfolio risk that you have in a portfolio. So if, let's say you have a stop loss at 50% of your trades, this reduces your portfolio risk by half. So what that means is that you can trade 2% of your account per trade. And when you have 5 consecutive losses, that's a 3% chance of a 10% portfolio loss. But if you apply a 50% stop loss to that strategy, now you have a 3% chance of only a 5% portfolio loss. So you can make some significant gains in your portfolio loss by applying or having prudent risk management tools on your existing option strategies, especially on your risk, on your limited risk strategies where you know how much risk you're taking. You can set stop losses to potentially prevent you from having significant further losses. So remember, when you're trying to trade and you're trying to calculate the appropriate number of contracts, number one, always have a mental note of the dollar amount you're willing to risk per trade. So look at this account value number table right now. Do some quick calculations. What is 2% of your entire account? If you have a larger account, you might want to skew to 1%. If you have a smaller account, you want to use 2%. But ask yourself, what's the number? If the number is $1,000, burn that number in your in a hole in your mind, or maybe put a sticky tape on your computer that says $1,000, and make sure that every single time you place a trade, you ask yourself, does the max loss of my trade exceed $1,000? If the answer is yes, don't get into that trade. If the answer is no, then you can potentially proceed with that trade. And what you do is you take the amount that you're willing to risk per trade, divide it by the max risk per contract, and that will calculate the number of contracts that you can trade. Again, OptionsPlay is a tool that you can utilize to help you do that using our risk and investment calculator. You don't have to do this math yourself. You just have to know how much am I willing to risk per trade, plug that into the risk and investment calculator, and that will show you the appropriate number of contracts that you can trade. And we will calculate for you based on the max risk of each strategy as to how many contracts that you can trade, and never trade more than what the contract calculator tells you in terms of the number of contracts. So just to remind everyone, you're playing an infinite game. Stop trying to win. Stop saying to yourself when you make decisions on trades, right? Especially a losing trade. And then this is where I think, what sets again professional traders apart from traders that may be struggling is the fact that when a professional trader sees that they have a loss and they've kind of hit their stop loss targets, they don't think much more than just cutting their losses and moving on. And they focus their attention on the trades that are going well and how they can maybe adjust those trades to turn small winners into large winners. That's where they focus their attention on. The exact opposite is what I tend to see a lot of self-directed traders do, is they focus all their attention on, I have this losing trade. What do I do to fix this losing trade? Instead, what you can do is just cut those losers. Focus your attention on those winning trades. See how you can turn that 50% gain into a 200% gain. You can adjust strategies to do that. Cut your losses. figure out where you want to spend your time on. And I'm telling you, don't spend your time on losers, spend your time on winners. So because guess what? You're playing an infinite game, not a finite game. There's no such thing as winning when it comes to trading. So stop trying to win. When you try to win every time, that's when you actually, ironically, in the attempt to trying to win every single trade, that's how you blow up your account. When we look at charts that look like this, right? What caused that person to buy over and over again? Is it because of their strategy? No, it's because they were hoping to win. They were hoping to be right. And it's the pursuit of winning and the pursuit of being right that causes us to blow those holes in your account. So remember, do everything you can to stay in the game by protecting your account. Ask yourself, how much am I putting at risk? When a trade goes south, ask yourself, am I putting myself at more risk by whatever adjustments that I'm trying to make? People ask me, how do I hedge a loss? How do I turn a repair trade? How do I do this and that? And the answer is almost always whatever you do to try to get yourself back to break even involves more risk. And again, when you throw good money after bad money, that's how you blow up your account. One of the ways to do that is to never risk more than 1% to 2% of your account per trade, so that each individual trade never is a large percentage of your portfolio. That means that if you have this one losing trade that blows a 1% hole in your portfolio, guess what? It's much easier to let go of that 1% loss than if that trade lost 10% of your account. You want to always minimize your portfolio drawdown at all times, and make sure that you plan that at some point you may have 5 to 6 consecutive losses in a row. Any trader that tells you that they're right 90% of the time is, they may actually be right 90% of the time, but the traders that are right 90% of the time usually have very, very poor risk to reward ratios, where that 10% of their time, they blow a huge hole in their portfolio. Traders that are just good traders will still always tell you that there is going to be times in the market where the market just doesn't agree with you. It just doesn't trade, or it doesn't work for the strategy that you're trading, and you're going to have these consecutive losses. And if you don't account for that, and you think to yourself that you're never going to have more than two to three losing trades in a row, the only person that you're really hurting is yourself by not believing that at some point in your trading career you're going to have these consecutive losses. If you plan for it, and you know that even if you have these 5 to 6 consecutive losses in a row, you're not going to blow a hole in your portfolio. That's how you're going to be able to progress as a trader and advance in the infinite game, if you will. And lastly, to help you kind of think about your portfolio risk, make sure that you think across all your expirations. Try to distribute your trades across multiple expirations, across multiple sectors, and think about being long and short at the same time for different, depending on the market conditions, so that you're not just concentrated in all long positions in all the same sector that all expires on the same day, which I have seen a lot of in many portfolios over the past few weeks. A lot of the portfolios were heavily concentrated in long technology names that were all expiring within 2 to 3 weeks, and you have one bad week where the markets are down 10%, guess what? There's no coming back from that. And this is why we don't trade 1 to 2 week options, so that when you have one bad week, it doesn't wipe out all of your positions, that you can adjust, you can continue to trade from there. So that is what I was hoping to teach everyone here today. I know I went a little bit over time, but this is the most important lesson for investors to learn when it comes to trading and being successful in trading, because I've been doing this for 15 years and I've seen a lot of traders struggle, unfortunately. And this is the one thing that differentiates successful traders from everyone else. So I hope that this was useful in helping you better understand this. And again, if this is your first time learning about infinite versus finite games, I have an interesting video that I think everyone should watch. It has nothing to do with trading. It's worth watching. It's by Simon Sinek. Many of you know who he is. He is one of the pioneers, in my opinion, of this theory of finite versus infinite games in the real world. And there are plenty of other applications of finite versus infinite games that you will find in your personal life. So the YouTube video that I just sent to everyone in the chat window is an interesting way of how he applies infinite versus finite games into the way leaders think about how they lead. And this is the same one that you'll be able to once you watch this video, hopefully that also helps you click, this thought process as to how you can apply that to trading, because it's not just applicable to trading. It's really applicable to a lot of things in life. And I think that by viewing this and seeing this, how he applies it to leadership, hopefully will also help snap and kind of just shift your thinking a little bit for how this applies to trading. So with that, thank you so much for taking the time out here this afternoon. I really hope that you guys find this useful. I have a few minutes to answer some questions. I don't have a lot of time, but I do want to try to answer some questions. If you have questions, please type them into the chat window at the bottom of your screen. There's a chat, I'm sorry. There's a chat window and there's a Q&A window. Please type your questions into the Q&A window. I apologize, it's been a long day. Please type your questions into the Q&A window and I will answer your questions here. Oh, Mark is saying, did you go back to the, great point. So let's go back to the scenario one, right? These are the two scenarios. If you sold the put at 292 and now the stock's trading at 260. So what should you do, right? So when you sell a put, you sold the put because you're comfortable buying the stock at 292. That's why you sell the put. Now, when the stock's trading at 260, how should you think about this question? The question, from my perspective, the answer is not, should you sell another put? Should you do this or should you do that? The question is, are you still comfortable buying the stock at 292? If the answer to that question is no, you should buy back the puts. That's it. There's nothing else that needs to be considered, because shorting the put is based on the original thesis that you're comfortable buying the stock at 292. If based on new information that you now have, you are no longer comfortable buying the stock at 292, you should no longer be in that put. You should buy that put and get out of that trade. And then after you get yourself out of that trade and take that loss and accept the fact that you're wrong in that trade, after that fact, you can ask yourself, would I be comfortable buying the stock at 260? Maybe based on the new information, you say to yourself, I am comfortable buying the stock at 260. And at that point, maybe it does make sense for you to buy another put at 260. But what you want to do is remove the two decisions away from each other. Remove the decision to sell that 260 put away from the fact that you're losing money on the 292 put. Once you are able to remove that, you're able to get a little bit more clarity on that. And I tend to find that 70 to 80% of the time, once you remove the losing trade from the second trade and you ask yourself, would I make the second trade if I wasn't already in that losing trade? 8 out of 10 times, the answer is no, I would not have sold that second put if I wasn't in that first losing trade. And that is some insight that I hopefully will help you better understand how to think about a losing trade and how to go about deciding what you want to do next. In the second example, I bought an NVIDIA 525 call for $3,500. It's now down 38%. Should I sell or hold? The question is, why did you buy the NVIDIA call at 525? And the question is not, should you sell or hold? The question is, does that original thesis still hold? So, for example, maybe you bought it because the stock broke out, or maybe at that time there was news on the stock and you thought to yourself that this is a great investment. Ask yourself, do I still think that's a great investment today? If the answer is no, the answer is you should sell your position, because guess what? You've already lost 38%. Do you want to lose another 62% on that, on the hopes that you get back to break even? The answer is no. That rarely works out. We tend to find that when you're down 40 to 50%, about 70% of the time, you're going to lose the other 60%. Only about 30% of the time will you get yourself back to break even and make a small profit. So based on that alone, I would always tell investors to sell. But is there a reason to hold? Absolutely. If the original thesis that you had as to why you bought these calls is still a valid thesis, and I don't know what that thesis is, only you know. Ask yourself, why did I buy these call options? And is that thesis still hold true? If the answer is yes, then hold on to your call option, right? You have limited risk. You know the fact that you were going to risk $3,500. Maybe you're comfortable with risking $3,500 and your thesis still holds, then hold on to it. But don't confuse the losing trade with what you want to do next. Always decouple the two from each other. Okay, so Mark, I hope that helped answer your question as far as getting back to the original example. And and you can ask yourself also, would you change your answer based on what you've learned here today? Chip is saying, when you buy an option in a day or two and it reaches 90% loss, but it has 50 days to expiration, do you manage or do you let it go to see if you can recover within your lost 2%? So if you've stayed within your 2% rule and you're down 90% and you still have 50 days to go, is the other 10% worth it? Probably not. Then you might just want to hold on to it. So, that's an extreme example. It doesn't happen very often, but it certainly is one of the few cases, in my opinion, where you can just let it sit because you've already lost almost all of the premium. I have an Apple 2020 125 strike leap. I'm down about $500. What do you recommend? Reed, I hope that, what I'm hoping to teach here is so that you don't have to rely on someone like myself to help you answer that question. I hopefully today helped you understand how to go through that question yourself and come to the right conclusions as to whether it makes sense for you to hold on to that call option or it's time to sell. I'm just completing my first month of options plating, and I find this very timely information due to my finite perspective and recent losses. Mark, I'm very happy to hear that you did learn this sooner than later. Many beginners, or not, I wouldn't even say beginners, many traders still think in this infinite game. But remember, trading is not a finite game, it's an infinite game. HH, I will be watching this webinar again, very insightful. I would say this is one of the webinars that is worth watching, rewatching at all times. Are you staying with the Apple trade? Great question, okay? So Drew is asking me about my Apple trade. This one's down 31%. Am I sticking with it? So here's how I'm viewing this. My original thesis, for those of you that did watch me on CNBC when I entered this trade, was the fact that I thought this initial sell-off was going to be contained because I didn't think that this was a larger structural sell-off in the markets, that I felt that this was purely due to delta hedging from market makers and that the markets were going to be contained in that sell-off. From my perspective, that thesis is still true. Now, I will say that it's hanging on by a thread. Apple's hanging on to that 110 level by a thread, which is a major support level here. And I also have the Qs, the NASDAQ 100 index, hanging on by a thread at that 270 level, which is also, for those of you that join us on Tuesday mornings, a major support level that confirms my thesis that this sell-off, which was only 3 days long, is contained. Now, again, my thesis is hanging on by a thread, but it is still true. And that's why I'm hanging on to my Apple trade. It hasn't reached my stop loss levels. It hasn't reached the number of days where it takes to start cutting out my trade, which is 21 days. And it still stays above my resistance levels. If the Qs close below 270, or if Apple closes below 110, and I said this on CNBC last week when we reviewed the trade, if it breaks below those levels, I would consider my thesis wrong. Even if I haven't triggered my stop loss levels, I would cut my trade. I would cut my trade at that point. But my original thesis at the moment still holds. Granted, it's only holding by a thread at the moment, but it still holds, and that's why I'm hanging on to it. On OptionsPlay, are there strategies if you're in a losing position? Again, Raheem, my take is that if you have a losing position, take the loss, move on to the next trade. And again, this is one of the insights that I have received from doing this for 15 years, is that the successful traders, they don't spend too much time worrying about their losers. They know that they have losers, they cut them very quickly, and they spend their time figuring out, how do I manage my winners, right? So when you have a losing strategy, before you get into the trade, you should already know at what point am I going to cut my losses and what point am I going to potentially take profits, so that it's not a decision that you have to make at that time. You don't have to be in a losing trade and then figure out, what should I do next? You should already know what happens at the time you have that losing trade. Once it's a loser, at a certain point, you say, I'm going to cut my losses and move on to my next trade. That's how professional traders, for those of you that have maybe sat in front of a screen staring at a losing position, just looking at the ticks go by, I've been there. Every trader has been there, where you have a losing position, you're just staring at the screen, hoping that it makes your money back. Professional traders don't do that. They let their losers, when it hits their stop loss levels, they cut them and they focus their time on which positions are going well. How do I turn that small winner into a large winner? That's where they focus their attention. And I hope that this helps you shift your thinking into that direction, because that's the direction that you need to head in if you want to become successful as a trader. Mitch is saying how to play snow. I'll be honest, I haven't looked at it. There aren't options listed on it. I know they had some pretty big gains on the IPO, but I haven't looked at it. And I generally will stay away from hypes like that. I stay away from Nikola. I stay away from these types of investments because of that. I know a little bit about the company. That's not something that I want to necessarily play at the moment until some of this hype and volatility dies down, and certainly until they list options. Does the investment amount include margin or actual cash? So I'm talking about cash when I'm talking about your account size. Wayne is saying, I've not heard much on teaching on trade logging and metrics. So Wayne, that's good feedback. I will certainly, think about what I think is important for you to log and think about, and I will make sure that that is sent out to everyone. Steven saying, why wasn't the Tom Sosnoff recording sent out? So if you're a member, you did get that email. Otherwise, you can go on YouTube. If you go to our YouTube channel, you can sign up for YouTube or register here for YouTube, and you'll be able to get access to our videos, which includes the one for Tom Sosnoff. I just included a link into the chat window, but we did send out the recording to everyone, actually, just for you, for those of you that didn't get it. Is it time to get out of the queues or Microsoft? Look, the queues are hanging on by a thread. I am surprised at how resilient the market is in holding that 270 level. We broke below that 270 level intraday last Friday, but closed above it. We went intraday below 270 again today, but managed to close back above it. There seems to be a lot of strength below 270. There seems to be a lot of buyers stepping in. At the end of the day, from my perspective, I don't think it makes sense to fight the Fed. From the perspective, yes, do I think technology stocks are overpriced? Yes, but where else do you place your money? If you pull out of technology, where do you put your money? There's some rotation into discretionary, there's some rotation into materials and industrials, but is that going to offset the market cap of technology? And the answer is no. Are you going to put it into fixed income that yields almost zero? The answer is probably not. So, for that reason, I don't see a huge amount of downside, in my opinion, to the Qs in technology. What are your thoughts about BA? BA also has been fairly resilient. Boeing, despite all the bad news and the delays, it continues to remain resilient. So I'm not particularly bearish on it. David is saying, Tony, you're an excellent teacher. Here is my question. If you're selling, if you're selling cover calls because your strategy is long the stock or ETF, do you consider the difference between the tax exposure into the risk? David, if you don't mind, send me an email at info@optionsplay.com. I'm always hesitant to answer tax questions. Number one, I'm not a tax professional, but I can give you my opinion on certain things, but I do want to understand a little bit more as to your question. So send me an email at info@optionsplay.com. Wayne is saying, is there an actual criteria that determines if someone's a professional trader? No, it's just a professional trader is someone who does this for a living and doesn't do anything else other than trading. That's how I generally think about it. And most professional traders are usually trading account sizes that are over $500,000 to $1 million, because realistically, to make a living on trading, you need an account size of that size. Tony, based on your rules, very few accounts can sell naked SPX puts. Antonio, you're absolutely right. And you shouldn't be selling naked SPX puts. But here's the thing, right? The thing about risk per trade when you're talking about selling an index is that you can consider, standard deviation moves into your calculations, because reality is, if I use SPY for an example, reality is that the S&P 500 is not going to zero in the month and a half that you're selling these options. But what you can use is the trading range simulator and saying, okay, in a really extreme example, if the SPY went down from 335 to 286, or even go down to three standard deviations, right? Maybe it's 250. Calculate how much risk you would take if you sold a naked put that way, and then have that stay within 2%. But you're right, it's not selling SPX. It's a $330,000 contract. You're right, it's not for someone with a small account. That's why you would sell SPY if I were you, rather than SPX. Is the market data delay 20 minutes in OptionsPlay? Yes, it says market data delay 20 minutes at the top of your screen. What if you have an account of $2,000 starting out, never exceed a trade of $40? So Dave, in theory, yes, but I would argue that if you have a $2,000 trading account, it's probably not the best trading account for trading options. I would say that if you're trading, a $2,000 trading account, you're trading options, you're likely speculating, you're likely taking on a lot of risk, meaning you're the type of investor, with $2,000 starting out, you're probably okay with risking $1,000 or maybe even $2,000 of the entire account on a few trades. It's not ideal, right? Because at some point you're going to come across risking, you might have 5 or 6 losing trades in a row. You might have experienced that 2 weeks ago when the market sold off 10%. When that happens, you've basically blown a very large percentage of your portfolio. And the only way to resume is by depositing more money. And that is a cycle that's going to continue to repeat itself, and if you're okay with depositing a few $1,000s every single, few months, because at some point you blow up your account, sure, you can do that, but I don't know that that's a very fruitful endeavor for most investors, to deposit $2,000, maybe make a couple of $1,000s and then lose a couple of $1,000. And it's just not if that's what you're going for, by all means, but, we're talking about sustainably growing your wealth and sustainably growing your portfolio. Abe is saying, hi, Tony, thanks for the presentation. Always helpful. How would you distinguish between an investment account and a trading account? So I would say an investment account is your retirement portfolio where you predominantly own stocks for the long run, mutual funds, ETFs. That is aside from your trading account. So when I'm talking about trading account, I'm talking about the account that you have at risk, at your discretion, that is effectively your discretionary account, if you will. Don't factor into your retirement account. Don't factor into those type of funds into your account decisions here. Trading the SPY weeklies for income using vertical spreads. How would one trade once a week, every week, to expect to have a better than 60% win rate? So Steve, this is why we never tell you to sell 1 week options, is because all it takes is 1 week, like 2 weeks ago, to wipe out all of your gains. We see a lot of trading, and most of the investors that blew up their accounts were trading these 1 week options. I don't advocate that you do that. That's simply just not the strategy that I would do. But if you were to do it, you want to make sure that the max risk of the credit spread that you're looking to sell, whatever that max risk is, that max risk stays within 2% of your account per trade. And if you're saying that you're only doing that one trade and you're not doing any other trading, can you exceed 2%? Sure. Maybe you might want to risk 5% of your account per trade when you're doing that, because that's the only trade you're making. So I would say most traders don't fall into that camp, but if you're only trading 1 trade a week and you're only trading that, then you can exceed that 2% rule. October 16th date is to get out next Friday at 9:25. Ron, I'm not sure what you mean by that. If you could let me know. Ed's saying, I missed the first 20 minutes. Ed, we are recording this, so you can watch this at your own pace. What do you do then? Your directional play doesn't play out in 2 to 5 days. You just get out or keep waiting until your loss loses 50%. So, if let's say you decided to go long SPY and over the next 2 or 5 trading days, it just kind of moves sideways, ask yourself, do I still think the stock's going to go higher? If the answer is yes, then hang on to it. If the answer is maybe there's some new information that you have now 2 or 5 days later, and you're saying that I no longer think the stock's going to rally, then cut your losses, even if it's only 10% loss. You always want to think about your original thesis and think about, does that original thesis still hold true? If the answer is yes, and you haven't exceeded your stop loss levels, hang on to the trade. If your thesis is no longer true because of new information that you have, and you're thinking to yourself, well, what I thought 2 days ago is no longer applicable, get out of the trade, even if it hasn't triggered your stop loss levels. Comfort level has nothing to do with fundamentals and technicals, but with risk. That is correct. It doesn't matter whether you're a technical or fundamental trader. You need to apply these risk metrics. Gary, thank you so much. I really appreciate it. If you have an option that loses 20% because of market versus macro reasons, nothing in the company changes, and you have 35 days to expiration, is it okay to hold the option because there's still time to expiration? Tony, yes. So especially if your original thesis still holds true, and because of market or macro reasons that you have about a 20% loss on an options trade, when I say 20% of the premium that you paid, then yes, that absolutely is a reasonable reason to hold on to that trade. Mark Ship, you're very welcome. Jim is saying, how do I determine the amount of risk for an undefined risk trade? Great question. So the question is, you usually look at, we actually factor this into the trade part. So when you say that I'm willing to risk, let's say I'm willing to risk $2,500. Notice how the max risk of the stock is actually $16,000, because what we're doing is we're basically saying that if the stock declines two standard deviations lower, I'm looking at about that $2,500 loss. So that's what we're doing here when we're looking at the unlimited risk strategies. Is we're looking at what is the max risk at two standard deviations move against you, and we calculate the appropriate number of contracts for you. So that's how our calculator does the work for you. So I suggest that you use our calculator to help you do that. In scenario one, what exactly happens when you get assigned to buy 100 shares of Facebook at 260? Because in my paper trading account, it seems to convert over to me being short 100 shares at 260. No, if you're short the put, it will always be long the 260, not short the 260. If you shorted a call, then yes, you'd be short 100 shares of the stock. But if you shorted the put, you'd be long 100 shares of the stock. One challenge is that if you put a stop price, that if the stock goes below and you exit, then the stock price goes up. How do you deal with that frustration? There's no way to deal with that frustration. You're going to be frustrated. The reality of trading is that you're never going to be able to buy at the very absolute bottom and sell at the very absolute top. That's the reality of trading. And if you're the type of trader that's frustrated because you didn't sell at the very top, or get out of the very bottom, or get out of the max risk, or max reward, I don't know what to tell you. That you're just going to be frustrated. You will never ever be able to extract the most yield or the maximum gain, and have the minimum loss on a trade. That's just not how trading works. So the sooner you can wrap your head around that and get used to it, the better you will become as a trader. Because the sooner you realize that losses are part of trading, the more comfortable you will be with just letting go of those losses, not letting those play with your emotions and cloud your judgment and lead you to do dumb things effectively, throwing good money after bad money. The sooner you can get your mind around that, the sooner you will become a better trader. With that covers what I want to share with you here today. I'm unfortunately not able to get through all the questions, but again, I do think that this is one of the most important topics. So if this is a new topic to you, if you're a new trader, take the time to learn, watch the recording. I will send the slides out to everyone so that you can watch it at your own pace. And watch that video on Simon Sinek. I think it's a great way to kind of give you a different perspective of infinite versus finite games and how it applies to your life beyond just this one concept of trading. Thank you so much. Have a great evening. And I'll see you guys tomorrow morning at 9 a.m. Bright and early. We're going to cover where markets are. Like I said, the market's hanging on by a thread here, but still in that bullish state. We'll talk about where we open up tomorrow morning. I hope that you'll be able to join us, and I'll see you guys on CNBC tomorrow night. Have a great night.